So last week we talked about the different risks we have to consider when investing in a business. We talked about macroeconomic risk, currency risk, and regulatory risk. In this video, we're talking about the balance sheet. So the balance sheet is a snapshot into the history of a company per time. And in the balance sheet, we talk about what a business owns and that which a business owes. So that which a business owns is called assets. That which it owes is divided into two: liabilities and then equities. So it has to be balanced. That is why the assets, it must be equal to the liabilities plus the equity. So assets, that which a business owns, and we used a 1 year frame. So for that which is 1 year frame, we can differentiate assets based on current and non-current. So for current, these are assets that can be liquidated within 1 year. Talk about things like prepaid expenses. Talk about stuff like account receivables. So for the prepaid expenses, we talk about things we've already paid for: advertising, insurance, any other stuff we've paid for before. That's what we call prepaid. Account receivables, these are money our customers are owing us. We've already rendered the service or supplied goods. We're just waiting for them to pay us our money. We have supplies. So supplies, we can take supplies to be anything a company owns, like things that are tangible, like office supplies or some other stuff that we can use to run our business, things like vans and the rest of them. So cash could be anything like debt certificates. It could be stuff like hard cash or anything that we can actually use. Things like we have inventory. So inventory is basically the goods we have in stock. Probably you are into the business of selling things, and the things that are remaining in your store that you could count and say, okay, I still have this left. That is what we call inventories. And then for the non-current assets, we have the likes of long-term investment, probably invested in assets that are outside of our business. So our business is involved in doing X, Y, Z, but we decided to invest in something in another business. So those are long-term investments. We have things like PPA properties, equipment, and then we have plants. And then we have intangible assets like royalties, intellectual property. Probably our company owns a logo that we make money off, or things like songs or music right or whatsoever. These are intangible assets. And then next on the line, we have liabilities. As you can see from the picture, you can see there's a man here with something like a weight on him. Anything the company owes third parties is called liability. So a third party could be a salary, the workers, and other persons, as we'll see. So we still use the 1 year time frame to differentiate liabilities. Based on that, we have current, then we have non-current. So for current, we have accounts payable, salaries payable. We have to pay those who work for us. We have taxes. We have accrued interest. We have paid and unpaid premiums. For non-current, we talk about the likes of long-term loans. Probably we took money from the bank to finance our day-to-day operations, and we need to pay that over time. Probably maybe in the course of X amount of years. And then we talk about things like pension funds. These are people who have worked for the company over time. They've now retired and they are on pension. Those are also liabilities on the company. We have things like deferred tax liabilities. Tax could be deferred. It's permissible under some jurisdiction, but you cannot default on tax perpetually. So those are also liabilities on the company. And then next on the line is shareholders equity. So anything that the business owes the owners of the business. So we have owners equity, and then we have retained earnings. So retained earnings, these are stuffs that can actually be plunged back to give the company more edge as it progresses. So before we end, we have two stuffs. We have other metrics you can actually look to rate a business, how a business is, the health of a business. We have the income statement. So the income statement is basically kind of profit and loss stuff. We're trying to compare things like revenue to expenses, and we're trying to see if our business has been profitable and the rest of them. And then you can take it to be like a video. Why? If you're comparing it to the balance sheet is like a snapshot, right? Just took a picture at a particular point in time, whereas the income statement is you trying to put the business under surveillance, right? And then cash flow statement is basically does not concern profit and the rest of them. All it does, we're trying to see. So your cash flow could be like you as a human, you make money and then you spend money. So you cash flow is you trying to compare to see efficiencies. Am I really being efficient with my money? Can I do less and then get more? So that is the whole stuff about cash flows. Can a business spend more? Can a business spend less and make more profits? So with cash flow statements, we're able to see our lapses as a business and then make the necessary adjustment. So a basic balance sheet looks like this. I downloaded one from the internet. You just compare a time frame. It could be a quarter to another quarter, it could be a year to another year, and then you just put the assets, the liabilities, and everything, and the measure go there. It starts to match. So thank you very much for sticking around.